I strongly recommend watching this video right to the end, as I will reveal a rather controversial but very interesting conspiracy theory about how so-called Bitcoin whales manipulate the price of Bitcoin. Hello everybody, it's Oleg Ivanov with you on the IvanovInvest channel looking at trend setters. In this column, my team and I will talk about some of the less obvious and hidden trends that may be useful for some of you and vital for the others. Subscribe so you don't miss out on the upcoming videos, and let's get going. And today, we'll dare to step on a very slippery territory: cryptocurrencies and Bitcoin in particular. Hundreds of channels, thousands of predictions, crowds of scammers, millions of victims and earners. Blockchain as an industry, whatever one may say, nevertheless has a kind of a flavor of fraud, grey schemes, darknet and shady characters who use the system for their questionable intentions. And at the same time, the foundation of blockchain is also becoming stronger and stronger, year after year, eating away business from traditional companies, starting from banks and insurance companies to the gaming industry, gambling, data storage, encryption, and so on. Bitcoin, for all of that, despite of its speculative nature, continues to remain a sort of a industry flagship, periodically causing excitement on the verge of greed during periods of rising prices or disappointment due to sharp price drops. So, what can you expect from Bitcoin in 2021? Many forecasts. Maybe too many, especially given the fact that hardly anyone can give a clear guarantee in terms of exact numbers and time frames. So today, let's go through 5 fundamental reasons why, in our very subjective opinion, Bitcoin will not reach a price level of $100,000 per coin, as many love to predict and scream about. And towards the end of this episode, we will share our price prediction for Bitcoin in 2021. So stay tuned. Reason number 5 is associated with the release of centralized digital currencies by central banks of different countries. Launching CBDC by different countries, starting with China, is a big thing. Firstly, CBDC is a digital currency, and many people are confused and think that digital currency is the same as crypto, but this is not the case. There are already many digital currencies around the world that have existed long before the blockchain market. PayPal, Kiwi, Yandex Money, WePay. In every country there is a whole set of digital currencies. Each of them is heavily regulated by the same central banks and is owned either by private companies or near state structures, and in fact are not much different compared to traditional fiat currencies. Such confusion plays into the hands of CBDC issuers, all kinds of digital national currencies like digital yuan or digital ruble, as in the minds of ordinary users the difference is barely noticeable. Why would a mass retail buyer need some kind of incomprehensible, semi-legal Bitcoin when you have a legitimate digital national currency which seems to perform the same functions? I can store this money, I can transfer this money. How and why should we buy Bitcoin? Where to store it? Where to sell it? What are the tax implications once the profit appears? Crypto adoption creates a lot of challenges. Number 4. Frightening legislation. Legislators in different countries have been introducing laws on circulation of cryptocurrencies with one hand, while issuing fines and prison sentences for crypto ownership and tax returns errors with the other. Let's just have a look at some of the countries where the crypto is either banned altogether or the legal status of it is constantly changing, starting with the Russian Federation with the latest law, India where crypto is banned, and China where crypto is either allowed or then banned, allowed again, banned again. In the USA, only 8% of the population has ever come into contact with cryptocurrency due to a heap of restrictions, and where regulators fine, arrest and force solid blockchain projects to shut down their cases make the news headlines all the time. Remember the last example of the Telegram messenger who was trying to launch Telegram Open Network as a blockchain and eventually was forced to close down the whole project altogether. For most people, when they weigh the potential benefit from the growth of an asset, which may not yet happen, no one can guess the upside, right? Versus the very specific risk of fines and prison terms, It becomes obvious that cryptocurrency remains an exotic, risky, and quite dangerous financial toy with a very vague benefit not yet ready for mass adoption. Number 3. Not necessary for the business. Due to constant volatility and unpredictability, Bitcoin is simply not reliable enough for large-scale global business. Moreover, Bitcoin is not suitable as a means of payment or lending due to reasons specified below. Let's have a look at them. 1. Constant price fluctuations. You constantly run the risk of incurring serious losses. Just imagine that you bought a product in installments on November 27 of this year when Bitcoin cost about $16,500 and you had to pay on November 30th when the rate soared to $19,600. For the same product that you have already bought, you suddenly have to pay 18% more in just 3 days. Crazy, right? Even if we don't take into account the time difference, there is still an exchange rate difference in that moment in different geographic markets. Just have a look at the Bitcoin price map. From the lowest prices in Chile, Argentina, Singapore, and the United Kingdom to the highest prices in Nigeria, Peru, Mexico, India, and South Africa. Imagine how you could settle accounts if you supply products from one of these countries and are thinking of settling in Bitcoins among yourselves. By buying Bitcoin in one of these countries and selling it in another, you can either win or lose a lot. As a means of backing up the company's assets, Bitcoin is not suitable due to its volatility as well. Company reserves are formed as a rule for difficult times. Often, when such times come, they hit hard on all assets, especially the most volatile. Bitcoin could quickly destroy a company's reserves if you bought it for $18,000 at the beginning of 2018, for example, and decided to use the reserve at the end of the same year when it dramatically dropped to below $3,500. It is not surprising that so-called stablecoins quickly took root for business and other tasks. They are pegged to a dollar and they simplify making settlements, accumulating funds outside the banking system, and even with the advent of the so-called DeFi market, making money on primitive banking products such as deposits, loans, insurance, and so on. It's hard to believe that a business will suddenly start buying and using Bitcoin en masse. Number 2. Obsolete technology. Bitcoin's transaction speed is slow and costs are high. Scaling infrastructure is a multi-billion-dollar task. The inability to create practically anything on top of Bitcoin blockchain protocol, unlike Ethereum blockchain, which allows developers to create their own automated solutions utilizing the entire grid. Any updates to the protocol face lengthy battles with miners, followed by the entire planet, fortune-telling whether 51% of the votes will be collected for a new iteration or not. When Apple needs to update its software, they simply upload it to the Apple Store, after which you will automatically receive a notification on your mobile phone, click OK, and voila! You already have the new software running on your mobile phone. With Bitcoin, updates are impossible until the majority of miners vote for this or that update, which of course can seriously affect their earnings or the balance of their interests. Many proposals that could advance the practicality and usability of Bitcoin are either stalled or simply not implemented due to the refusal of miners to lose their control and subsequently their earnings. On the other hand, dozens and dozens of new protocols have been practicing for several years now, each in its own direction to solve narrowly focused problems. Some are good for corporate sectors, some for payment systems, others for banking industry, some for small businesses, some for gaming and gambling industry, while others remain at the technological level, linking different blockchains with one another. As a result, the blockchain market has specialized into very specific niches, so much that a superficial glance is no longer enough to understand and benefit from the market. Summing it all up, it has become clear that the potential for rapid growth will not come from the rapid technological advances, but rather from the teams who are able to apply this technology into certain specific and narrow business solutions. For instance, take a look at the Wi-Fi token developed by Andre Cronje or NFT tokens, many of which have not only surpassed BTC this year in terms of profitability, but also in absolute price. Since the technology continues to change with accelerating dynamics, most likely a higher growth rate and further capitalization should be expected from bright and experienced teams that have already done something before on their blockchain market and have now taken on new tasks. And now to the final argument number 5. Bitcoin whales manipulating the price. 80% of volume of Bitcoin purchase and sale transactions take place off the radar, not on exchanges but on the so-called OTC platforms. Furthermore, many exchanges manage such sites. You may find them on Binance, OKX and a bunch of other exchanges. To understand the logic influencing the behavior of large players, it is enough to draw an analogy with ordinary industry where there's wholesale players and retail buyers. A wholesale player always buys large quantities at low price and then sells it all to retail buyers at a higher price. It doesn't matter whether it is potatoes, Coca-Cola, real estate, Tesla shares or Bitcoin. Moreover, the smaller the market, the more manageable it is, the more convenient it is and easier it is to influence. So, how are the markets influenced? By influencing the flow of information that influences the behavior of retail players. Now, pay attention to this. A scenario is created in which something is very wrong with Bitcoin, bans, court cases, etc., which is shared with the media. Then we go to the top 10 world crypto exchanges, which turn over about 20% of the total volume of Bitcoin, while making about 7.5 billion USD against the total capitalization of about 360 billion United dollars, which is about 2% of the entire tradable volume of Bitcoin. And with this 2% of the entire BTC portfolio, we buy back these volumes from exchanges, dropping the price to the desired threshold. Panic on the market. Retail players begin to believe the information released the day before. This info is picked up on all other info channels and crypto bloggers. Retail players start selling in panic to avoid bigger losses. All this time, large players are buying these incoming volumes at low price, both on exchanges and on OTC platforms. After buying Bitcoin at good prices and waiting for the panic to subside, positive news are released. Against the backdrop of positive news, the same whales on the same exchanges begin to drive the price up with the same 2% of their volumes. There is a stir in the market, retail consumers are already beginning to believe that the market has changed and are starting to buy Bitcoin heavily. Whales then sell this more expensive Bitcoin, which was bought earlier much cheaper, first to retail clients to maintain the desired high price level, and later to larger OTC players. Further, as the main target volumes are sold, this cycle repeats again and goes into the negative news in order to collapse the price and buy Bitcoin at the bottom. If this hypothesis is correct, then the paradigm here includes the banal cost of such fraudulent schemes. Obviously, with a Bitcoin price of 20,000, such actions for buying and selling on exchange to swing the price will cost 5 times than with a price of 100,000. In other words, the same whales will need 5 times less money to manage the market and earn their managed margin. Of course, everybody chooses for themselves what to believe in, and our team and myself are of course influenced by the blockchain industry and the cryptocurrency, so we definitely believe in the fundamental principles and the good benefits of the technology itself. And at the same time, regarding Bitcoin, we believe in the 2-3 times growth scenario as the most optimistic plan for 2021. First of all, Bitcoin is compared to kind of a digital gold, the emission of which is limited, just like the proper gold. Therefore, the gradual growth of interest in it and the gradual purchase of this asset in small amounts to create a new stock and not as a means of payment, a completely logical model that can pull the price of Bitcoin up. If you believe in the technical analysis, and here you can read a little bit more information in my Telegram channel about the Bitcoin price after the so-called Bitcoin halving events, then the price rise to the corridor of 60 to 80,000 per Bitcoin is quite likely in the next 1 or 2 years. However, all this of course will take place only with the confluence of an increasing variety of factors. And of course we have to mention our disclaimer. This video should in no way be perceived as a financial or investment advice or other call for investment activity. Here, we're simply expressing personal, possibly erroneous opinions about trends that we subjectively pay attention to. Subscribe to the channel, leave your comments down below to let us know what other topics you would like us to open up in our next videos. This was Oleg Ivanov on IvanovInvest channel with Trendsetters. Have a good one.